Hello and welcome back to the lesson. The subject is Advanced Financial Management. The topic is mergers and acquisitions. In today's lesson, we're going to outline the criteria for choosing an appropriate target for acquisition. Criteria for choosing an appropriate target for acquisition. Candidates, choosing the right target for acquisition is a critical decision in mergers and acquisitions that significantly impact the success or failure of the deal. It requires a systematic and a disciplined approach. It requires evaluating both qualitative and quantitative factors. In this lesson, we are going to highlight the key criteria for selecting an appropriate acquisition target. And the first point is strategic. In choosing an appropriate target for acquisition, it is very critical to consider the strategic fit. This is arguably the most important criterion because the target company must align with the acquiring company's long-term objectives and vision. And when looking at the strategic fit, it's important for the target, for the acquiring company to consider the market expansion. Market expansion. Market expansion. The question that the acquirer has to answer in relation to market expansion is, does the target company help the acquirer enter new geographical markets or consumer segments? Another question will be in relation to diversification, product diversification. And the question here to answer is, does it add new product lines? Does the target add new product lines? Does the target add new product lines? Services or technologies that complement or enhance the acquirer's existing offerings? Three, in analyzing the strategic fit of the acquirer, is a competitive advantage. Competitive advantage. Competitive advantage. Does the target strengthen the acquirer's competitive position, perhaps by eliminating a rival, or gaining market share, or acquiring proprietary technological or intellectual property? 4, supply chain integration. The vertical integration. Does it improve efficiency? Does the target reduce costs? By acquiring a target, does the acquirer gain control over the supply chain? And so on. You understand? Yes. So that's the first criterion. The second criterion is financial performance and health. Financial performance and health. When choosing a target for acquisition, it's important to consider the financial health of the target. There ought to be a thorough assessment of the target's financial standing, which is paramount to ensure it is a sound investment and can contribute positively to the acquirer's financials. The target should focus on revenue growth on profitability, revenue growth, profitability, debt levels, C, valuation, and so on. What do you mean by revenue growth? This is looking at consistency and sustainable growth, which may indicate a healthy and expanding business. So before acquiring a target, the acquirer should consider revenue growth, should consider profitability. The target must have strong profit margins, like the operating net profit or gross profit, and also positive cash flows, which demonstrates operational efficiency and financial stability. Another metric is the debt levels. The target should have manageable debt to equity ratios and a healthy balance sheet, which reduces financial risk for the acquirer. We have valuation candidates. Valuation. The target's valuation should align with the buyer's budget and expected returns, which prevents overpayment. You understand? There's also return on investment. We need to not to forget return on investment is a key financial metric that has to be considered when choosing an appropriate target for acquisition. Return on investment. The acquisition should promise an attractive return on the capital invested. That is the second criterion. The third criterion is synergies potential. Synergies potential. Synergies potential. This is a very key aspect. This is the ability to create synergies, which is often a primary driver for mergers and acquisitions, representing the combined value exceeding the sum of individual parts. For example, you may have cost synergies. Cost synergies. Cost synergies. This is the potential for cost saving through reduced overheads, streamlined operations, consolidated purchasing, and just elimination of redundant functions. We have revenue synergies. Revenue synergies. These are opportunities to increase revenue through cross-selling products or services, accessing new customer bases, or even just expanding into new markets with combined offerings. Operational synergies. The acquirer has to consider operational synergies. This is just improvements in efficiency, improvement in productivity, or utilization of assets. The fourth criterion is in relation to market position and industry dynamics, market conditions. Market conditions and industry dynamics. Market conditions or position. Market position. This is market position and industry dynamics. Market position and industry dynamics. This means understanding the target standing within its industry and the broader market trends is also crucial. So before acquiring a target, it's important for the acquirer to consider the market position of the target. Market position of the target. And when analyzing the market position and industry dynamics, the acquirer has to check the market share. What is the market share? What's the market share? Because a strong market position or leadership in a niche can be highly attractive. So before acquiring a target, the acquiring company has to check the market share of the target in the industry in which it operates. 2 is growth potential. That is the target. That means that the target company has to consider the growth potential of the target. The acquirer has to consider the growth potential of the target. Does the target operate in a growing or emerging market segment or not? Because if it operates in an emerging market segment, then that offers great future prospect. Analyze the competitive landscape. The acquirer has to analyze the competitive landscape, understanding the target's competitive advantages, barriers to entry, and how it differentiates itself. And how it does what? It differentiates itself. Furthermore, candidates, the acquirer has to keep in mind the regulatory framework of the target, the regulatory environment. Are there minimum regulatory hurdles? Will the merger come with the favorable legal requirements? So here we are talking about minimal regulatory hurdles and a favorable legal landscape which can simplify the integration process. The 5th criterion is management team and human capital. Management team and human capital. Before one acquires a target, before the acquirer acquires the target, then the acquirer has to check the quality of the target's leadership and the workforce, which is also very significant and sometimes underestimated. This sometimes is an underestimated factor. One key aspect of management team and human capital is experienced management. Experienced management, because a competent and experienced management team can ensure smooth integration and continued success post-acquisition. Cultural compatibility. When choosing an appropriate target for acquisition, cultural compatibility is a factor that should not be ignored. This is the alignment of values, work environment, leadership styles between the two companies is also vital for successful integration and employee retention, because there may be cultural clashes which can lead to M&A failure. Cultural compatibility. Then there is key personnel retention. Key talent retention. Key talent retention. This is the ability to retain critical employees and key management post-acquisition, which is essential for preserving the target's value and expertise. This is the 5th criterion. Then the 6th criterion is operational considerations. Operational considerations. Operational considerations. There could also be practical aspects of the target's operations which need careful evaluation, like operational efficiency, operational efficiency. Operational efficiency. That means how well does the target run its operations? Are there opportunities for the acquirer to improve efficiency? That's what we mean by operational efficiency, and that could be in relation to systems and technology compatibility. Systems and technology compatibility. Systems and technology compatibility. Systems and technology compatibility. That is the ease with which the target's IT systems, the software and operational processes can integrate with the acquirer. Another key aspect here is infrastructure. Infrastructure. Candidates, we are discussing the criteria for choosing an appropriate target for acquisition. We are on the sixth one, which is operational considerations. For example, we've highlighted operational efficiency, systems and technology compatibility, and infrastructure. Infrastructure. That means the quality and the scalability of the target's physical and technological infrastructure. You understand? Yes. 7. Risks and liabilities. Risks and liabilities is the 7th criterion. The acquirer should conduct thorough due diligence, which is essential to identify and assess all potential risks, like the legal and regulatory risks. Legal and regulatory risks. Legal and regulatory risks. This has to do with compliance issues. The acquirer should check if there is any ongoing litigation, competition concerns, or just potential regulatory changes. Environmental. There is also, as part of risks and liabilities, there is environmental liabilities. Environmental liabilities. The acquirer has to check any past or present environmental issues that could result in significant costs or penalties. Then there could also just be hidden liabilities. Hidden liabilities. This is in relation to undisclosed debts, contingent liabilities, or off-balance sheet obligations. 4. Reputation risks. Reputation risks. The acquirer has to check if there is any negative public perception or reputation damage associated with the target. 5. Intellectual property risks, intellectual property risks. That is to mean strength and enforceability of intellectual property and potential infringement issues. So this is the 7th criterion. Then the last criterion is exit strategy. When planning to choose an appropriate target for acquisition, the acquirer has to have what we call exit strategy. And while focusing on the acquisition, it is also prudent to consider potential future exit scenarios or how the acquisition fits into the broader portfolio strategy. So this is the criteria for choosing an appropriate target for acquisition. Number 1, strategic fit. Number 2, financial performance and health of the target. Number 3, synergy potential. Number 4, market position and industry dynamics. Number 5, management team and human capital. Number 6, operational considerations. Number 7, risks and liabilities. Then lastly, we have exit strategy. Exit strategy. So candidates, by meticulously evaluating the potential targets against these comprehensive criteria, acquirers can significantly increase the probability of a successful merger and acquisition transaction that delivers long-term value. That's all for today's lesson on choosing, or the criteria for choosing appropriate target for acquisition. Bye.